Hello everyone, I am Pratap here. We are at part 6 of lesson 21. This is about bull or bear traps. And these lessons are having dependency on the earlier lessons. In case if this is your first visit to our channel, please understand we are providing complete free training on supply demand zone price action. All the training lessons are available at our NeoStock YouTube channel in a playlist Supply Demand Zone Price Action course. I have provided the link to this playlist in this YouTube video description. You please click the link, you will get into this page. And then scroll down to the bottom of this page. Here starting from lesson 1.1, all the training lessons are available in an order. So please go through all these lessons one by one. And then you can get into the part 6 of lesson 21, that is about bull or bear traps. So institutional traps. So what are institutional traps? So in general, how do you trade? We prepare our plan. You apply all the concepts you learned in supply demand zone price action course, and then you will identify your entry zone and also you will identify your target zone. So based on that, you will identify your entry, you will identify your target, you will also identify your stop loss, and then you plan your trade. So after planning the trade, what will happen? Sometimes we might experience prices move against our trade plan. You are expecting the zone will work, it will give you good profit, but unfortunately, the prices will be moving against your plan. And then your entry zone will be violated. At your distal line, the zone will be violated. And below the or above the distal line, depending on demand or supply zones, you will keep stop buffer. And thereafter, the prices would hit the stop loss at stop buffer. That means your trade is stopped out. Once your trade is stopped out, what you will do? So you will exit from your trade because our trade is stopped out. We exit from the trade. So the moment you exit from the trade, sometimes you might experience prices again reverse and move in favor of your earlier trade plan, and finally they reach the target. But you exited from the trade, and you will be thinking, how it happened? How can prices are reversed? Again they moved in my favor and reached the target. You might be thinking, if I would not have exited because it is stopped out, I would be getting so much profit I would have got. This is how you feel. Why such kind of things will happen sometimes? The reason is because of institutional traps. You might not have noticed those traps. So that is the reason why first your zone is stopped out, you exited from the trade, thereafter prices again reversed and moved in your favor. So let us discuss such kind of traps in this video. Look into this situation. The prices are moving up and down, and look into these peak points. Same point again it reached. Again, once again, same point it reached. If you are a conventional technical analyst, you might be knowing the concepts, support and resistance levels. This is an example for the resistance level. If you draw a horizontal line, this is called resistance level. Prices are getting resistance at this point of time or at this price level. See again, second time at this price level. Again, third time. If it is 2 times, you may say it is double top, or 3 times you may say triple top. But if it is at all-time high. But in between also such kind of situation you will be seeing. Then you will call them as a resistance level. If it is at the bottom, you will call it as a support level. So some of you might be knowing these concepts. So when you have such kind of concept, what traders will be doing? We have different category of traders, and one of the category of the traders is, we call them as a breakout traders. Breakout traders, they always look for such kind of price action. So what is their belief? When such kind of resistance levels are broken, prices will be moving very sharp. So the moment this resistance level is broken, they will take an entry. Because it is a resistance level, they go for a long trade. Once the resistance level is broken, look into this example. See, now resistance level is broken. And breakout traders, they will take long trades at this level. Some people will take immediately the resistance level will be broken. Some people take some buffer and then they take their entry. They don't follow demand and supply zones principles. They may or may not. That is all depending on. Some demand zone traders, if any retracement to the zone after this level is broken, there they take the entry. These are the different techniques people follow. If you are a conventional technical analyst, you may not be knowing anything about demand and supply zones. Just blindly to take a trade the moment zone is, the moment this level is broken. So what is the belief? Now prices will be moving very sharp and you get a lot of profits. But see what happened. Let us assume all the breakout traders took the long trade. So all of you took the long trade. So when you took the long trade, what will happen? The prices should sharply move up. But that didn't happen. Now instead, prices moved down in a sharp way and further they went down. Now all the breakout traders are trapped. I repeat, all the breakout traders are trapped. Why they are trapped? Because sometimes institutions will create the traps. Who are the breakout traders here? They are all called bulls. So all the bulls are trapped here. Whatever the long trades, all these long trades are captured by the bears. Once there are no more long trades, they pushed the market down. So these kind of traps you need to understand. So that is what we are going to discuss in this video. So institutional traps are two types. We can categorize them into two types. First one is a bull trap and second one is a bear trap. So let us discuss about this bull and bear traps. Because one of these trap I will give you a detailed discussion. Same concept you can apply to the other one. So the other one I will give you the more examples. First let us focus on the bull trap. A bull trap is a short name for bulls are going to be trapped. Bulls means long trades or long traders. We have long trades and short trades. Long trades means buy orders. Short trades means sell orders. So all the buy orders or long trades, they are nothing but bulls. And these bulls are going to be trapped. Why they are going to be trapped? Because we set a trap for them. We set a trap for the bulls. That's why short name we call it as a bull trap. Sometimes people will understand this term in a reverse way. People may think maybe this trap is set by the bulls. That's why we are calling it as a bull trap. No, that is wrong. Bull trap means it is a short name for bulls are going to be trapped. They are getting trapped. Bulls are getting trapped. That's why it is a bull trap. So who will set this bull trap? Obviously bears. So it is a trap set by the bears. Why they are setting? To grab the liquidity generated by the bulls. Because we know that is the area all the bulls are going to buy. A lot of buy orders will be there in that area. That means so much of liquidity is generated in that area. The entire liquidity we want to grab. That is what the meaning of grabbing the liquidity. So who wants to grab that liquidity? Bears. Whatever the number of orders, bull orders, everything they want to get it. Bulls are buying and the bears are keep on selling. Then only bulls can buy, right? After some time, bulls will be completely exhausted. There won't be any more liquidity. And that is the time bears will be started pushing the market down. But these kind of situations will happen in some special scenarios. So you need to understand those special scenarios. So let me tell you what are those special scenarios after some time. But time being, remember, these traps will be set only in some special scenarios. You need to understand this meaning. I will also give you some examples to understand this meaning during the examples discussion. But remember, this is very, very important point. That's why I highlighted it. Because I have seen some beginners will be thinking, even in our group also I have seen previously. They are thinking that everything what they learned earlier or what the examples they have seen, everything is like a trap. That is what some wrong misunderstanding they got. So I don't want you people to get into that wrong misunderstanding. Traps will be there only in some special scenarios. Those special scenarios you need to understand by analyzing the chart properly. But I am yet to explain what exactly these special scenarios. Please remember. Until you learn these special scenarios, don't skip the video. Because I have seen some people are just doing fast forward, they are learning. Don't do that. Okay, next point. In supply demand zone price action, a bull trap can be identified as, this is at the high level. Please remember. Not at the micro level or detailed analysis level. At high level, I am explaining you. In supply demand zone price action, a bull trap can be identified as a lower time frame supply zone. That means you are learning one important point here. Mostly traps will be in lower time frame zones. Not higher time frames like 75 minutes or daily or weekly. You can't set traps in those time frames. So which time frames generally institutions will set? Last 3 time frames. That is a 15 minutes level or 5 minutes level or 1 minute level. You will be seeing the traps. Because it is a bull trap always they set using supply zones. So maybe you may find a bull trap in 15 minute supply zone or 5 minute supply zone or 1 minute supply zone. And the ideal scenario is a 5 minute supply zone. Mostly you will see in 5 minute supply zones. Sometimes you will see in 15 minutes or 1 minute in rare situations. And a bull trap can be set above higher time frame, high liquidity supply zone. It is very, very important. See, I told you earlier, in some special scenarios only. Every zone they won't set. Some special zones they will set. What are some special zones? High liquidity zones. So most of the times institutions keep a bull trap above the high liquidity supply zone. Most, I am using the word most of the times, but means not always. Sometimes they don't set the traps. That day we will be thinking, we see a 5 minute zone just above our supply zone, high liquidity supply zone. We think that is a bull trap. We take a trade and the zone will be easily violated. So that way we will be stopped out. But such kind of scenarios will be there rarely. But many times you will be seeing bull trap above the high liquidity supply zone. But also you should remember, not always. Some high liquidity supply zones, they could be weak high liquidity supply zones. They could be weak. In weak high liquidity supply zones, probably there won't be much order flow will be there. That means there won't be much liquidity. When there is no much liquidity generated in the zone, there is no meaning in setting a trap. That is the way institutions feel. That's why they leave those zones. So once your experience grows, you will understand these zones in a much better way. You will understand the order flow in a much better way. Then easily you can assess, yes, definitely this is going to be a trap. At least your assessment will be 80 to 90% correct once your experience grows. But initial stage, maybe 60 to 70% level, your assessment will be right, 60 to 7%. But maybe up to 30%, maybe your assessment might be wrong and you may be failed. But anyway, 70% success is a very good success. 70% level, you are assessing it is a trap and it is working. That is a very good, excellent in supply demand zone. Not 70%, even 50% above, 50 or above is a very good assessment in supply demand zone price action. So that's why you should understand the word in some special scenarios very carefully. A bull trap can be set above higher time frame, high liquidity zone. And if you are already having knowledge about conventional technical analysis concepts like support and resistance levels, above the support level, resistance level, institutions will keep bull trap. And I don't know how many of you are aware, there is a concept called channels. You have channel. We can create channels in by using conventional technical analysis. If the channel is breakout, a little above the channel breakout, they can keep a trap. I think a few months back, maybe some 3 or 4 months back, I have seen above the channel institutions kept a bull trap. The channel is broken to the upward side. Just above that I saw 175 minutes supply zone. I have a strong belief that the supply zone will be act as a bull trap, because all channel breakout traders immediately they go for a long trades, and the stop will be supply zone. Definitely it will push the prices. This was my understanding at that time. I think it is about some 4 months or 5 months back. I don't know, at the time our channel is created or maybe not active, or maybe some 6 months back also. I'm not sure, I didn't remember, but you can find that post in my LinkedIn, because probably that could be my first post or second post in my LinkedIn account. So go through my old post. People, whoever is having knowledge about the channel, probably you can find. This is how, because not only if you are a purely technical analysis trader, you may not be knowing conventional technical analysis concepts like support resistance, or maybe channels, triangle patterns. You have like head and shoulders, cup and saucer, you have flag. So many concepts, patterns are there. But anyway, they are not very, especially in 60s and 70s, 1960s, 1950s or 1970s, that time these concepts has given a very good profits for the traders, because at the time technical analysts are very few. But once the technical, more and more people are learning technical analysis, institutions also understood how exactly people are using. Now they used those concepts for trapping the traders. When institutions are trapping, obviously what happens? Those concepts does not work properly. We are all getting caught by the institutions. That way those concepts nowadays, they are not giving proper results. Because I used all these concepts between the years 2003 to 2009 or 10. I mainly, because at the time the supply demand zone price action concept was not there in the market. So people are not aware of any of those concepts. I think from 2008 or 2009 onwards, supply demand zone concepts are getting popular in US market. And probably from 2015-16 time onwards, in India people are started coming to know about supply demand zone. But those numbers are very small. Now in the recent time, especially for the last 2-3 years, more and more people are coming to know about supply demand zone price action. So that's why between the years 2003 and 2009 or 10, between those years, I was mainly using all these patterns, indicators, several indicators and volume-based breakouts, like how some of you people are doing nowadays. Same way I was doing in those years. So I'm aware of all those concepts. That's why I know where exactly institutions are creating the traps, not only based on the supply, because we are focusing high liquidity zones. High liquidity zones point of view, I am providing you the training. I am not entering into conventional technical analysis. If you are using those concepts, how you will be getting trapped? I am not getting into those concepts. I just gave you one example in the previous slide. How resistance level, once if it is broken, how institutions are getting, institutions are trapping all those bulls. So anyway, this is the story behind how institutions are started trapping the conventional technical analysis traders. Now same mechanism also might happen to our high liquidity zones also. So that's why the important point you should understand, a bull trap can be set above higher time frame high liquidity supply zone. What is our high liquidity supply zones? Mostly we are focusing on daily and 75-minute zones. Because in our HLQ strategy, we built based on daily and 75 minutes. So if you are aware of these concepts, many times you will get profits. Look into this example. So a demand zone is getting created here. Now further price is pushed up, and now a supply zone is also created. Let us assume the supply zone is either a daily or 75 minutes high liquidity supply zone. This is what we are doing in our high liquidity trade setup. But remember, this concept can be used not only for high liquidity zones. Even same concept you can use it for bullish trade setup and bearish trade setups also. Please remember, in any supply demand zone price action you can use. But where it is having more probability is high liquidity zones. At high liquidity zones you can see higher probability of setting the traps, because there is a lot of liquidity will be there. So institutions can grab that liquidity. So that's why we are focusing on high liquidity zones. But also you should remember, same concept can be used in bullish bearish trade setups also. Again prices came to the demand zone, again went up, once again. See, because this is a high liquidity zone, maybe multiple times it is pushing the prices down. That way you can understand. In this area the liquidity is more. This is a normal demand zone, already tested once, more deep, and this time this demand zone is violated. Once a demand zone is violated, is there any use with this demand zone? No, you can remove the zone from the charts. That is what you learned earlier. Now again prices are started moving up. While moving, again a new demand zone is created. Once again prices went into this high liquidity zone, and once again it pushed the prices down. And now once again reached the target zone, because opposing zone is the target. And from here again prices moved. Maybe here you want to take a order here. Somewhere, let us assume, in this area you might be having a fine-tuned zone. You might have taken a short order, but what happened? Your zone is violated. Probably your stop loss would have been triggered in this area. Let us assume exactly at this candle side. Now at this your stop loss, your stop buffer is just now stop buffer is violated, because this is the distal line. A little above you will keep your stop buffer based on your daily ATR concepts that I explained in the earlier lessons. Let us assume now exactly this is the stop buffer. Price just crossed the stop buffer. Let us assume. Now what you will do? Being a short trader, what you will do? This is my question. Because your stop buffer is violated. So immediately what we do? We exit from our order. Because what might happen? Sometimes prices will be further going up, and your loss will increase. You will get heavy losses. The strict rule we have to implement: once the stop loss is hit, you must exit from the trade. This is the rule. Forget about these traps and all. Whether there is a trap or not, we don't bother about that. Always we respect this principle, stop loss. Once the stop loss is triggered, you have to exit whatever the loss you are going to get. Because that loss you already calculated. You might have calculated that loss. Because you know the stop loss before it, well before taking the trade. That means you might have already calculated the stop loss, whatever the value you are getting. That means you might be already knowing how much risk you are going to accept. Because this is your accepted risk, you might have taken the trade. Somewhere here you might have taken the trade at this level, and at this level probably this could be your stop loss. Once your stop loss is, what was your trade earlier? Short trade. Once the stop loss is hit, what trade do you take? Long trade you will take. Because earlier your trade is short trade. How do you exit from the short trade? By going for the long trade. Long trade means it is a bull trade. All long trades are bull trades. Like you, so many people might have taken a trade, all their stop losses are hit, you will exit from your trade. That means you are generating so many long orders. And not only you, there are also breakout traders. What breakout traders will be doing? They might have observed in this zone, prices are always, it is pushing down. That means this zone is acting as a resistance level. This is a resistance level related zone. And all the breakout traders might be expecting, once the zone is violated, I want to go for a long trade. Why? Because it will be pushing the market up. You get a lot of profits. This is how breakout traders will be analyzing the charts. Now all the breakout traders might have also took the long orders. That means now we have seen two types of orders here. One is a long order to exit from your trade because it hit your stop loss. And some other people are taking long orders not for exit. That is a fresh trade. Because they are expecting market will go up. Because this is the area, it is acted as a resistance for several times. Because this level is broken, their expectation is market will be flying now. It will be moving up. That is what they will be thinking. That's why they all might have gone for a fresh long trade. Now all your trades will be captured by the institutions. Because more and more people are buying here. That means long trades means buying. More and more people are buying. Prices may further go up. See, prices further moved up. But still, institutions are still capturing all our orders. And if you look into the lower time frame, say for 5 minutes or 15 minutes level, at this level, you may find a zone, a supply zone, lower time frame zone. And this 15 minutes or 5 minute zone could be a bull trap set by the institutions. And here they might have added so much of order flow, sell order flow. That's why whatever the breakout traders are buying and whatever stop loss hit traders are again buying, all these trades are getting captured by the institutions. Which kind of institutions? Bears. Now these bears are trapping the bulls. That's why we call it as a bull trap. That means bulls are getting trapped. See, all these bulls are getting trapped here. Because here institutional sell order flow is very strong in this area. So much of orders they kept. How much orders they kept? Until all these bull orders are exhausted. That much sell orders they kept in this trap area. At any point, they don't want to let the bulls push the market up. They don't want that happens. That's why whatever the bull orders, they want to capture everything. And finally now what happened? This is completely exhausted. Which one? All the bull orders. There are no more long orders are available. And because the short orders, institutions keep on selling. Now finally, there are no more long orders. Because of the selling pressure, see again what happened to the price. Again it pushed the market down. And finally, the prices came and closed inside the daily 75 minutes high liquidity supply zone. But this zone is pierced. Pierced zones are nothing but zone is violated. What is the main advantage of pierced zones? It is helping us to identify the traps above that. This is the reason why I introduced the concept of pierced zones. I have created a special video about pierced zones. You have important analysis playlist is there. There you can find a special video about pierced zones. I think almost 6 months back or 5 months back, I recorded a video how to make use of pierced zones. One advantage of using pierced zones is it will help you identify some traps. So the zone is pierced mainly because of bull trap. See, everything will happen in just a few minutes time period. It won't take, because all the people are, all the stop losses are happening at the same time. If your stop loss, my stop loss, everybody's stop loss will be triggering at the same time, because we are all trading according to the demand and supply zones. Because the system analysis will be same for all of us. If anybody do a wrong analysis, probably his entry stop loss will change. But as long as you follow the principles, all of us will take the trades maybe at the same time, or all of us will exit almost at the same time. So that's why all these orders are captured at same point of time. At the same point of time, the breakout traders also exited. They're also getting captured. If you see this, everything within few minutes, this price action will complete. Maybe you see this is a 5 minute zone. Assume this is a 5 minutes candle. Let us assume, time being. So everything happened. And after that, market further moved up and reached our target zone. This is our entry, this is our target. So such kind of things you will be seeing because of this bull trap. Exactly in the reverse way, bear trap also you can experience. The same analysis is applicable even bear traps. Bull traps are happening at the supply zones and bear traps will happen at the demand zone. It is exactly the reverse. I will show you in the examples. The same analysis I will show you in the examples for bear trap. But this is a detailed discussion I have given you just to make you understand what's really happening in this area. See, first you have seen this candle. It went up to our stop loss area. So we exited. Breakout traders also, they took a long trades. After that, prices went up to this bull trap area. Institutions, they captured all the long trades here. They didn't let the prices go up. And there are no more long trades. Now, institutions sell orders, I repeat, institutions sell orders or short trades again pushed the market down. That's why we are seeing a long wick. And not only this, we are also seeing the zone as only a pierced zone. We are not seeing the zone as completely violated. It is a pierced zone. Most of the times the traps will let the zone as a pierced zone. They will not let the zone violated completely. Many times, or majority of the times. After that, prices will be further moving down until your target zone. If the market hours is almost at the end of the market, maybe they may not reach the target zone, but near to the target zone, the prices will be closed. See, when this bear trap is getting executed, how much time trading hours is left out, everything will be having dependency, whether to achieve your target or not. But most of the times, prices will reach our target zone. This is the way you get a very good profit during the intraday. Sometimes these traps will be further pushing the market down for weeks together. If you look into the recent Nifty 50 analysis, same thing happened. Maybe some of you might be watching this video after 1 year. the word recent Nifty analysis may be applicable to you. That's why let me show you the timestamp. When I am recording this video on 4th May 2024. In 4th May 2024, let me open the chart and show you. That would be best thing. Let me show you the recent Nifty chart. This is a 5-minute zone, is a bear trap. This is a bear trap. Because for demand zones, it is a bear trap. And above that zone, there was a 75 minutes high liquidity zone was there. Daily zone is also there. A zone confluence, multiple times in that zone, it has given a profit from the somewhere here, these zones and all. Within this area, we got the profits. Again, here also. And finally, it reached, all these zones are violated, and finally reached this bear trap. See here, when this bear trap is executed, 18th April. And today is 4th, May 4th, 2024. This is 18th April, 2024. So almost 2 weeks, see how the prices were flying. Till 30th April. Now 30th April onwards, there was again some down movement. Maybe up and downs will be there, but you have to see continuously for 2 weeks how the bear trap pushed the market. Let me show you from daily time frame the same thing. You will understand. So this is a 5 minutes trap. This is a 5 minutes bear trap. How it pushed the prices. This is the closing. During that intraday on that, it has given a very good push. Those who have taken intraday trades, they would have got a good profit on that day. From here, it came to the trap. See how many points that day Nifty has given. This is a 21,800, and the closing of this candle is 22,147. Nearly 350 points move it has given during the intraday. Even after that, see next day with a gap up, how it moved up. Again further, how it moved up. Maybe one day it is down, again next day how it moved up. Only yesterday the prices were moved down sharply about 172. Who knows? Maybe Monday again prices. Monday means today is Saturday. Maybe Monday again trading session, it may go up. That possibility is there. We can't rule out anything. But this is the power of the trap, institutional traps. That is what you should understand. And while doing this Nifty analysis, in that video I clearly explained, definitely this is going to be a very good trap. If you refer Nifty analysis videos, so the analysis probably I might have done after 20th March to 19th April, in between those dates, refer the analysis videos. In one of the videos, I clearly said, this is going to be a very good trap, institutional trap. I told our members, this is going to be a very good trap. Institutions, nicely they set up the trap. Because I have seen the entire analysis, the price structure, and my experience clearly identified this is going to be a powerful trap. See how powerful it is. If you look into this price action, you will understand. This is how institutions behave. But what we all think, okay, our zone is violated and we exit from the trade, and we will, because the moment your stop loss is hit, even though it is your accepted level, that because when you are going for a trade, you know how much loss you are going to get if your analysis fails. If we accept that loss only, you will take the trade. Otherwise, you will avoid the trade. You accepted, you know that probably you will be losing maybe 0.5% or 0.6% or 0.7% or maximum up to 2%. Your risk accepted level is there. Once you take a trade means you are already accepted. You know that you are accepted. But if it is stopped out, the analysis went against us, we will be getting disappointed. That is the one thing we have to control. When you are taking a trade means you accepted and taking the trade. You are accepting the risk and taking the trade. But when you get the stop loss, why do you want to get disappointed? That is a wrong thing. So what many people will do, the moment somewhere here your stop loss is hit, let us assume this is the zone low, let us assume. Why I am saying zone low? Because you have a leg in, you have a rally candle, you have a base candle, again you have another rally candle with gap. Probably a zone will be there, a daily zone here. This could have been our daily demand zone. And here it is stopped out. Because it is stopped out, you will be disappointed and then you will be going out of your terminal. Under 2-3 hours you will feel sad, you won't bother what is happening on your market. Basically we run away from our terminal for some time because it is stopped out. But just below there is an institutional trap is there. If you would have noticed, you would have taken a trade, whatever the stop loss you got from this particular zone, everything you would have recovered and still you would be in profit. And if you are holding the positions, imagine how much profit you would have got up to this level. Because Nifty reached up to the new all-time high. Many times what happens is just reach all-time high, institutions above the all-time high, they keep sell orders and they push the market. That is what happened. Sometimes after reaching all-time high, prices will be moving up. But today's market is very volatile market. Definitely anybody having a minimum knowledge about stock market, they will guess the moment it reached the new all-time high, definitely institutions will push the market down for some time. Previously also we have seen the same. When market is very strong, at the time market reaches new all-time high, then from there market will be further moving up. It will be flying. So anyway, the point I am trying to say, the power of these traps you need to understand. This is a classic example for bear trap. But anyway, we are discussing about bull traps. But why I am showing you this? Just to make you understand the power of the traps. The point I was telling earlier, these traps also will push the market after several days also. See, several days, this is a trap pushed the market up. So it reached the target. From here it may further go down. But it is all depending on how strong this zone. Assume institutions created this zone as a high liquidity zone. Then maybe it is difficult to break this. Maybe again it will push the prices up. After that, this trap, whatever the trap, that will be violated. Because institutions might be happy only for one time push. And whether this trap is only for one time or it will work multiple times, they are all depending on the other conditions. Your supply demand zone concepts like your trending, ranging related concepts. Within trending, is it bullish trade setup or bearish trade setup? All other factors, what you learned, the lessons from lesson 11 in your training course, from lesson 11 to lesson 15, whatever the concepts you learned, they all will be applicable. But at least one time it has given a very good profit. Whether further the flow will continue or not, that is all depending on the other factors. That is what you should understand. But our high liquidity zone strategy point of view, we are focusing on the intraday related way. So intraday, definitely you will get a very good return on the investment. Many times you will get during the intraday around 6% ROI you will get based on one futures margin cost. Around 6% you will get. Many times. Let me show you some examples also. You will get clarity. So this is the first example. And the name of this stock is Dalmia Barat. This is a 5 minutes bull trap above this 75 minutes high liquidity supply zone. This is a 5 minute chart. This entire thing is a 75 minutes high liquidity zone. And above that high liquidity zone, we have a 5 minutes bull trap institution set just above that. See this zone worked several times. See here, this is the first entry, came down. This is the second entry, came down. Third entry, see how much down it has come. This is again fourth time, again came down. This is the fifth time. We have a fine-tuned 5 minute zone. And from this fine-tuned 5 minute zone, price has reached the target. Actually, this is a type 1 proximal entry. And same zone again we can plan for a trade for type 2 also. But this time it is violated and get into the bull trap area, and bull trap again pushed the prices to the target 15 minutes demand zone. But let me show you this same chart very close to this time frame. Now look into this. This is the 5 minute zone. We have a drop, base, drop. See, it looks like a medium sized candle, right? At the hidden body, it is also having hidden body. Then this is a good enough to consider the leg out. This is acting as a trap. And earlier, whatever the trade I shown you, successful trade from here to here, that is a type 1 proximal. Now what we are doing, we are planning for the type 2 proximal on the same zone. Earlier we got type 1 entry, now we are looking for type 2 entry because the risk is very big risk zone. Many times type 2 entry also it will work because it is a high liquidity zone. So that was our trade plan. But what happened? Today prices entered into this zone, but not good enough, and pushed the prices down, not good enough to until this 15 minutes target. Again recovered, and this time our fine-tuned 5 minute zone is violated. Because it is violated, it might have hit our stop loss somewhere here. The moment it hit the stop loss, what you do? You want to exit from your short trade. Earlier you took a short trade here. Maybe in this candle you would have taken a short trade. In this candle, your short trade is stopped out. Because it is stopped out, you need to exit. Definitely you should go for a long trade. Long trade means buying. That means bull. So you are all taking bull trade. It's not only you. Like you, so many people might have taken short trades in this fine-tuned zone. And all you people will exit somewhere here the moment it hit your stop loss order. Stop loss. The moment it hit stop loss, all you people, not only you, all the people who have taken short trade, mostly at the same time, you all will exit from your short trade with the long trades. And all these long trades are nothing but together it is going to be bulls. All these bulls are captured by this bull trap. This bull trap is a 5 minutes supply zone above this high liquidity zone. Now all your long trades are captured, not only you, because high liquidity zone is violated, which is tested several times. There will be breakout traders. They will be waiting for this zone to be violated. Once such a zone having huge liquidity is violated, according to them, the prices will be moving up very sharply. They don't want to miss. Breakout traders also might have taken so many long trades here the moment this supply zone is violated. And all these breakout traders, long trades are also bulls, indicates bulls, bull orders or bull trades. All these bull trades, that means all the bulls are captured in this 5 minutes zone by the institutions. After that, there are no more bulls. And then all the pending orders in this, all the institutional orders pushed the prices down until the next 15 minutes target. There was some kind of movement here, maybe because all these breakout traders, all their trades are stopped out and they might have exited somewhere here. So slowly, ultimately reached the target. And this is the way Dalmia Barat has given over 6.8% ROI during the intraday. That is excellent profit, right? Let me show you another example. This is about HDFC Bank. This is a daily supply zone. We have a drop. Actually, this is a daily chart. We have a drop, base, drop. And above this daily zone, there is a small zone that is a bull trap. This 5-minute supply zone is a bull trap. And previously what happened, HDFC supply zone is having a fine-tuned 5-minute zone. See here in this candle, prices entered into that zone and then pushed the market down. That day intraday traders would have got a very good profit, the fine-tuned 5-minute zone. And because this fine-tuned zone is already tested, next time we can't plan a trade. But above this zone, near the distal line of this zone, observe very carefully, near the distal line of this daily zone, there is a 15-minute zone. These 15-minute zones will be used by 15 minutes traders. Generally, they place trades at 15 minutes. But we didn't plan a trade in that. The reason is, we know the zone will be violated. The reason is there is no inside 15, there is no fine-tuned 5-minute zone. But many of the 15 minutes traders, they never know about this concept. There should be a fine-tuned 5 minutes, otherwise the zone will be violated. There are higher chances zone will be violated. They don't know all those things. So definitely they keep some short trades at 15 minutes. All these short trades are captured by the institutions. How they capture? They make sure the prices will go up, it will hit the stop loss, and then you all will exit with long orders. All our long orders will be captured by the institutions, and then they push the market down. Let us zoom this chart to 5 minutes and we will see. See here, this is a 5-minute zone, the recent price action. Here you have a fine-tuned 5-minute zone. Already earlier we took a trade here. That's why recently we didn't plan, because we know the zone will be violated. So easily zone is violated, because all the orders are captured earlier trade. And this is a 15-minute zone. This is also easily violated, right? Why? Because there is no fine-tuned 5-minute zone. We know that. But 15 minutes traders, simply they keep their short orders here. Now this 15-minute zone is violated. Now institutions, they are waiting for that. Once the stop losses are hit somewhere here, they go for all the 15 minutes traders will go for covering their short orders. That means they go for long trades to exit from the trade, because stop loss is hit. Because so many people are exit from the same time, a lot of liquidity will be generated. This entire liquidity is grabbed by the institutions from this 5 minutes bull trap. See, after that, see how prices came down. For some time this movement will be there. Generally it will be there sometime, because all these, whoever is breakout traders, whoever is placing a fresh long trades, their trades are stopped out, prices are coming down. So some kind of a consolidation will take place, and after that again finally prices reaches the target. But here anyway, by end of the day, prices reach to the list. You might have exited somewhere here while closing them, before closing the market. So this is the way HDFC Bank has given 4.1% ROI from here to here. I think that day by using some 1 minute trailing stop loss, we exited the trade. I didn't remember where exactly, because this is a old chart. I captured this screenshot from our HLQ analysis videos. So somewhere we exited in 1 minute, maybe somewhere here maybe. But whatever it is, HDFC Bank has given 5 minutes, 4.1% ROI during the intraday. by using 1 minute trailing stop loss. So this is about HDFC Bank bull trap. Now let's look into bear trap. What is bear trap? It is a short name for bears are going to be trapped, or bears are getting trapped. Bears means short trades. And it is the trap set by the bulls. Why they are setting? To grab the liquidity generated by the bears in some special scenarios. What is the special scenarios? We already discussed. In supply demand zone price action, a bear trap can be identified as lower time frame demand zones, as we discussed earlier for bull traps also. Generally, these lower time frame demand zones could be 15 minutes or 5 minutes, 1 minute demand zones. And their institutions keep a lot of order flow in that trap area. Generally, a bear trap can be set below higher time frame, high liquidity demand zones. The higher time frame, high liquidity demand zones could be daily or 75-minute zones. Because we are using high liquidity strategy, we are talking about high liquidity zones. But if you are looking from the conventional technical analysis point of view, traps will be set in different at support resistance levels. They keep the traps. And when people are using more of these channels, they will keep the traps. If you are a head and shoulder or cup and saucer based trader, or flags and pennants, or triangle patterns are there, you are triangle patterns based traders. In all these places, institutions will select to set the traps. Ultimately, they need to identify a location where they should confirm there could be a maximum liquidity will be there. Such kind of areas they will select. Without liquidity, there is no meaning in setting a trap. So that's why they set such kind of zones or such kind of concepts. But our focus is in supply demand zones. So I'm limiting my discussion to only supply demand zone, high liquidity zones. Look into this example, Biocon. This is a Biocon 75 minutes chart. We have a rally, base, rally. This is a 75 minute zone. Inside we fine tune with 15 minutes. Again fine tune with 5 minutes. This dark green color is 5 minute zone. And below that we have a 5 minutes trap, bear trap. See, prices came to the trap and moved up. Let me show you very closely. See, this is a 5 minutes chart. This entire thing is 5 minute zone. Inside 5 minutes we have a 15 minute zone. Inside a 15 we have a fine tuned 5 minute zone. Actually, this is the area where you want to plan our trade. Already this zone has given one trade, that is type 1 proximal. See this candle? This is the type 1 proximal entry. And see the huge rejection and see the movement. Definitely this rejection indicates there is a strong order flow. That's why we are planning one more trade, but this time in type 2 proximal. But it didn't work out. Why it didn't work out? The reason is this time institutions have decided to trap us with this 5 minutes bear trap. So it is stopped out. Because it is stopped out, what do you do? Somewhere here you will exit from your long trade. When you want to exit from the long trade because your stop loss is hit, so what do? You go for a short trade. Like you, so many people will go for the short trade. Just below there is a 5 minutes bear trap, and it is very near to that reachable distance. At least reachable distance should be there. The moment zone is violated. Suppose if the zone is a fine-tuned zone is far away, institutions won't keep the traps. Earlier I told you I will teach you a technique. The technique is how to identify really there will be a possible trap is there or not. At least 80%, 70 to 80% scenarios, we can identify the traps based on the location of the fine-tuned zones. If the fine-tuned zone is near to the 5 minutes trap area, mostly the traps will work. It is far away, institutions can't push the prices up to here to grab the liquidity. At the time it won't work. And also remember, institutions, they look from 2 points of view. One is 5 minutes point of view or even 15 minutes point of view. Because there are many traders, they take trades at 15 minutes level, not at the 5 minutes level. 15 minutes level they take the trades. They don't bother about the 15 minute zone is fine tuned zone or not. Because we developed a concept, if 5 minutes fine tuned zone is there, then only the zone will work. Otherwise, there are higher chances the zone will be violated. Because we developed a concept when a zone will be violated. Because this concept is not there in the market. Okay, now from us people will learn and they will start teaching this concept. Because this concept is not in the market when a zone will be violated. If 15 minutes zone is there, simply they place their orders in the 15 minutes. If the 15 minutes is not having a fine-tuned zone, the zone will be easily violated. See this 15 minute zone, this is very close to the trap area. And the moment stop loss, maybe somewhere here their stop loss will hit, it will exit. Here all the institutional order flow is there. It will capture all their orders and after that they pushed the market up. Finally reached the target. That's why always remember, when a traps will be really work or it is not a trap, at least 70 to 80% level you can identify. For identifying the technique is your fine-tuned 5 minute zone or 15 minute zone, fine-tuned 15 minute zone should be close to the distal line of the zone. Need not overlap with the distal line. It can be close to the distal line. If that is the case, institutions get enough space to capture their stopped out trades and also to capture the breakout traders also. Because the distance is good enough. If 15 minutes, this is the stop loss. Below some buffer they will use, maybe up to here. Now they will exit because the stop loss is hit. At the time they exit, they are in the 5 minutes bear trap area. So they are exiting in a wrong way, in a wrong zone. The moment they exit, see in the next minute the prices are pushed up. And they will be thinking, okay, I exited, but now again prices are moving in my favor. That way they will be thinking. But by the time the damage is already happened, right? So that's why understanding whether the bear traps and bull traps are very, very important. Let me show you the next example. Vipro, 5 minutes bear trap. See Vipro, this is a daily chart. We have a drop, 2 base candles and a rally candle. At the hidden body, you get a explosive rally candle here. So in Vipro, inside daily zone, we have identified a 75 minute zone, 15 minute zone, 5 minute zone. But this 5 minutes is very close to the zone below this. Our trade is stopped out. The moment trade is stopped out, what institutions will do? They will capture all our stopped out trades from this trap and again they push the prices up. Let me show you in the 5 minutes time frame. Actually, I am showing you in the 1 minute time frame here. This is a 5 minutes bear trap, but the chart is 1 minute chart. The reason why I am showing you 1 minute chart to explain the target. Generally, our target is 15 minute zone. But here 1 minute's high liquidity zone is there. Drop, base, drop. See, several times it is holding the prices here. Maybe it could be a high liquidity. Even before that, see, the rejections, it's not letting the prices. Definitely this zone is having something special. If that is the case, it will not let the prices go beyond that. In such kind of situation, you should not wait to reach up to this area. You have to wait. See, finally what happened, this fine-tuned 5 minute zone is violated and prices came to the trap. Institutions captured all our stopped out trades. Your stopped out trades are nothing but short trades, because earlier you took a long trade. Your zone is stopped out. Once it is stopped out, you have to go for a short trade to cover your long position. So like you, so many people are going for short trades to cover their long positions because of the stop loss. Now what happened? All of a sudden huge liquidity is generated. So the moment huge liquidity is generated, all the liquidity is captured by the institutions by using this 5 minutes trap. Because all the bears are captured, we are calling it as a bear trap. After that, see the push. It's a very good push. And moreover, this push is during the last half an hour of trading closing session. Next half an hour trading is closed. Still, we got an entry within just 15 minutes time. It reached this 1 minute high liquidity target. And this is the way Vipro has given around 5.1% ROI. Intraday ROI as per one futures margin cost. Excellent profit, right? So this is what you should understand about these traps. But remember the technique I told you. If the fine-tuned zones, which one, 5 minutes or 15 minute zones, are close to the distal line of the zone, there are higher chances that the 5 minute zone below the high liquidity zone will work as a trap. At least 70 to 80% scenarios, the 5 minute zones will work as a trap. When if you have a 5 minute zone or 15 minute zone, fine-tuned zones. What is fine-tuned? Suppose, let us assume this is a daily. Inside a daily, you have a 75 minute zone. Inside a 75, you have a 15 minute zone. That 15 minute zone is a fine-tuned zone. You may ask a question, can't we check for 5 minute zone? We will check because we know the concept. Many people doesn't know this concept. What they do, they take a blind trade at a 15 minute zone. There are many people. 15 minute zone, they take a trade without checking fine-tuned 5 minute zone is there or not. That is the concept we developed. Why we developed? To verify the zone will be violated or not. For that we developed, not for taking the trade point of view. To check the quality of the zone point of view, we developed the concept. That's why we know if fine-tuned 5 minutes is not there, mostly the 15 minute zone will be violated. Suppose if fine-tuned 5 minutes is there, you can take entry at 15 minutes. You need not wait up to 5 minutes. Sometimes your price may not reach up to 5 minute zone. From 15 minute zone, it take an entry and it will move up. That day we will be thinking we missed our trade. But 15 minutes traders, they get the trade. Because most of the 15 minutes trader, they are the short term traders. They may carry their positions overnight. Next 2 days or 3 days, they will hold up stock. And after that, they will exit. Anyway, we have a 15 minute zone near to this. Even 5 minute zone is also near to that. That means it is a very good stock for the institutions to capture the bears. Bears means short trades. You take a long trade only. But when it is stopped out, your long trade is stopped out, you have to exit from the trade. At that time, you have to take short trade. Those short trades are captured by the institutions from the 5 minutes demand zone. Below this 75 minutes are daily high liquidity zones. So that's why this 5 minutes demand zone is acting as a bear trap. Because all the short trades are getting trapped by this 5 minutes demand zone. This is how you should remember. And also please remember when to use and when not to use the traps. Because I have seen some people are thinking every 5 minute zone below or above high liquidity zone is a bull or bear trap. This is the way people are thinking. No, that is not right. That is wrong. That's why in the points I clearly told you, in some special scenarios, understanding the word in some special scenarios is very, very important. To make you understand one special scenario, I gave you the example. What is the example? The zone, the 15 minute zone, the fine-tuned 15 minute zone, or the fine-tuned 5 minute zone. Either one should be close to the trap zone. If it is close only, they can capture your stop order trades, institutions. If the distance is very high, let us assume the distance is somewhere here, this zone is there, this is the trap, and you exited here. Then they can't push up to this, near to this zone, right? It is impossible for them to push. You will exit somewhere here. When such a gap is there, it is very difficult to capture your your stopped out trades. So that's why institutions make sure your 15-minute zones or 5-minute zones are near to the distal line of the zone. That's why always remember, if your fine-tuned zones are not near to the distal line, it need not be exactly at the distal line. It can be near. See, the 15-minute zone is near to the trap zone. See the next example. The Vipro zone, 5 minutes fine-tuned zone is exactly at the distal line of this zone, just below 5 minutes trap. So somewhere here you will exit from your trade. It is easy for them, easy for the institutions to capture all our short trades. That is the liquidity. What is liquidity? Same time so many people are taking the trades. That is the liquidity. When same time people will generate so much of liquidity, when some special scenarios happens, special scenarios like your trade is stopped out, or the zone is broken, at the time breakout traders will be ready to take fresh trades. When so many people are taking fresh trades at the same place, a lot of liquidity will be generated. That liquidity these institutions wants to capture. That way you have to understand. That is what the meaning of a liquidity grab. Hope these examples are good enough for you to understand the bull and bear traps. And you can also find more examples. If you look into our previous HLQ analysis videos, if you refer the Excel sheet I post every month about high liquidity zones, in the comment section I will talk about bull or bear traps whenever they exist. So you can look into that video date. The timestamp is available when we recorded that video. So you can go to that date and you can refer the video. That way you will get more examples. So this is about bull and bear traps. So in the next session we discuss about dynamic entry buffer. Already dynamic entry buffer one video is available in our important analysis videos playlist. It is available. I think some 5 months or 6 months back I have recorded a video for the reference purpose. Anyway, next video we will discuss this. Hope this information in this video is helpful to you. Let us all meet again in our next training lesson. Thank you.